Financial ratios are key metrics that provide a quantitative way to assess a company's financial health and performance. Investors, analysts, and business leaders rely on these ratios daily to make informed decisions about the company. In this presentation, we'll explore 6 main categories of financial ratios that offer critical insights into a business. These ratios cover areas like profitability, liquidity, solvency, efficiency, and market performance, giving a comprehensive view of the company's overall standing. Understanding how to interpret and apply these ratios is essential for making sound financial decisions. Financial ratios are numerical calculations that show relationships between different financial data points. They are derived from a company's financial statements like the income statement, balance sheet, and cash flow statement. The purpose of financial ratios is to allow comparison between companies of different sizes. They provide insights into a company's operational efficiency. The key sources of data for financial ratios are the 3 main financial statements: income statement, balance sheet, and cash flow statement. Financial ratios simplify complex financial data into easy-to-understand metrics. They allow you to compare a company's performance over time and benchmark against industry standards. Ratios can act as an early warning system, identifying concerning trends before they become crises. Ratios provide data-driven insights to support investment decisions and guide management strategy. Financial ratios can be categorized into different types, each providing insights into a specific aspect of a company's financial health. Profitability ratios measure a company's ability to generate earnings and profits, such as profit margins and return on assets. Liquidity ratios assess a company's ability to meet its short-term obligations, like the current ratio and quick ratio. Solvency ratios evaluate a company's long-term financial stability and its capacity to meet its long-term debt obligations. Efficiency ratios measure how effectively a company is utilizing its assets, such as inventory turnover and asset turnover. Market prospect ratios reflect the market's perception of a company's value, including the price-to-earnings ratio and market-to-book ratio. Coverage ratios assess a company's ability to meet specific financial obligations, like the interest coverage ratio and debt-to-equity ratio. Profitability ratios are key metrics that provide insights into a company's financial performance and management effectiveness. The 3 main margin ratios are gross margin, operating margin, and net profit margin. These show how much of each sales dollar is converted to profit at different stages of the income statement. The return ratios ROA, ROE, and ROI measure how efficiently the company is using its assets and equity to generate returns for investors. These ratios give us a comprehensive view of the business model's viability, the success of the company's pricing strategy, and overall management effectiveness. Analyzing these ratios in depth can uncover important insights to guide strategic decision-making. Liquidity ratios are key financial metrics that measure a company's ability to pay its short-term obligations. The 3 main liquidity ratios are the cash ratio, quick ratio, and current ratio. The cash ratio is the most conservative measure, looking only at a company's cash and cash equivalents. The quick ratio excludes inventory, which is less liquid, to get a more immediate view of liquidity. The current ratio looks at all current assets versus current liabilities for a comprehensive liquidity assessment. The optimal range for the current ratio is typically between 1.5 and 3.0. A current ratio below 1.0 signals potential cash flow problems, while a very high ratio may indicate inefficient use of assets. It's important to understand these ratios and where a company's liquidity stands relative to industry norms and best practices. Working capital is the difference between a company's current assets and current liabilities. It's a key measure of a company's short-term financial health and ability to pay its obligations. I've provided some example companies with their current assets, current liabilities, and working capital ratios. Company A has a ratio of 2.0, indicating they have $2 in current assets for every $1 in current liabilities. Company B has a higher ratio of 3.0, suggesting stronger short-term liquidity. Company C has a lower ratio of 1.2, which could signal potential cash flow issues. Generally, higher ratios are preferred, but too high may mean resources are being used inefficiently. Industry benchmarks can vary significantly, so context is important when evaluating these figures. Solvency ratios provide important insights into a company's financial health and ability to meet its long-term obligations. The debt-to-equity ratio measures financial leverage by comparing total liabilities to shareholders' equity. Lower values indicate less reliance on debt financing, which is generally preferred. The debt-to-asset ratio shows the percentage of a company's assets that are financed through debt. Higher values suggest greater financial risk. The interest coverage ratio indicates a company's ability to pay interest expenses from its earnings. Higher values demonstrate stronger debt servicing capacity. Analyzing these three key solvency ratios can give us a comprehensive understanding of the company's overall financial stability and solvency. Debt management metrics are key indicators that lenders use to assess a company's ability to service its debt. A strong position is indicated by a DSCR over 2.0 and low debt-to-equity ratio, showing the company can easily cover its debt obligations. An adequate position has a DSCR between 1.25-2.0 and moderate leverage, indicating the company can meet its debt service requirements. A concerning position has a DSCR below 1.25 and high leverage, suggesting the company may struggle to make debt payments. DSCR is calculated by dividing EBITDA by debt obligations. Higher ratios make debt servicing easier. Lenders rely heavily on these metrics when making credit decisions, though industry norms can vary significantly. Efficiency ratios are key metrics that help us understand how effectively a business is utilizing its assets and resources. The first ratio is asset turnover, which measures how efficiently a company is using its total assets to generate sales. A higher ratio indicates better asset utilization. Next is inventory turnover, which shows how quickly a company is selling through its inventory. A higher ratio means inventory is selling faster. Accounts receivable turnover looks at how efficiently the company is collecting payments from customers. A higher ratio indicates faster collection of accounts receivable. Finally, days sales outstanding calculates the average number of days it takes to collect payment from customers. This provides insight into the company's cash conversion cycle. Understanding these efficiency ratios can help us identify areas for improvement and make more informed business decisions. Market prospect ratios are key financial metrics that help investors assess a company's valuation and growth potential. The price-to-earnings (P/E) ratio shows how much investors are willing to pay for a company's earnings. It reflects growth expectations. The price-to-book P/B ratio compares a company's market price to its book value per share. It indicates how the market values the company relative to its assets. The price-to-sales (P/S) ratio looks at a company's market capitalization compared to its annual sales. This is useful for evaluating companies that don't have earnings. The PEG ratio factors in a company's growth rate by dividing the P/E ratio by the earnings growth rate. This helps assess if a stock is fairly valued given its growth prospects. Understanding these ratios provides important insights into a company's valuation and growth potential that can inform investment decisions. Coverage ratios are important financial metrics that indicate a company's ability to meet its financial obligations. The three key coverage ratios are: interest coverage, EBIT divided by interest expenses. This shows how easily a company can pay its interest costs. Debt service coverage, net operating income divided by total debt service. This measures the company's capacity to make debt payments. Fixed charge coverage, EBIT divided by fixed charges. This looks at the company's ability to cover its fixed financing obligations. Higher coverage ratios generally indicate a stronger financial position. They demonstrate the company has sufficient earnings to service its debt and other fixed costs. Lenders and credit rating agencies closely monitor these metrics, as they influence a company's credit ratings and borrowing costs. Payout ratios are an important metric for understanding a company's dividend policy. The dividend payout ratio shows the percentage of earnings that a company pays out as dividends. A low payout ratio suggests the company is reinvesting more of its profits back into the business for growth. A high payout ratio may be attractive to income-oriented investors who want regular dividend payments. Dividend yield shows the annual dividends paid per share relative to the current share price. High dividend yields can be appealing, but need to be balanced with the company's growth potential. The visual examples on this slide help illustrate the different components of payout ratios and dividend yields. Industry-specific ratios provide valuable insights into the performance and efficiency of businesses in different sectors. In the retail industry, sales per square foot measures how effectively a store is utilizing its physical space, while inventory turnover shows how efficiently merchandise is being managed and sold. For banks, net interest margin reflects the profitability of their lending activities, and the loan-to-deposit ratio indicates how much of their deposit base is being utilized for loans. In healthcare, revenue per patient demonstrates the pricing efficiency of services, and occupancy rate reflects how well a facility is being utilized. Financial ratios provide a structured way to analyze a company's financial health and performance. We'll go through the key steps in the financial ratio analysis process. First, we need to calculate the relevant financial ratios by extracting data from the company's financial statements and applying the right formulas. Next, we'll compare the ratios to industry benchmarks to identify any performance gaps compared to peers. Then we'll analyze historical trends in the ratios over time to spot improving or deteriorating patterns. It's important to interpret the ratios in the proper context, considering factors like the current business cycle and company-specific circumstances. Finally, we'll use the insights from the ratio analysis to inform strategic decision-making and implement any necessary corrective actions. Ratio analysis is a powerful tool, but it's important to avoid common pitfalls to ensure accurate interpretation. One pitfall is isolated analysis using ratios without considering the broader business context can lead to incomplete conclusions. Another issue is ignoring industry norms. Failing to benchmark a company's ratios against sector-specific standards distorts the meaning. The company's life cycle stage also matters. Startup ratios differ from mature companies, so this context is crucial. Finally, seasonal variations can cause short-term ratios to fluctuate, so single point-in-time analysis can be misleading. The DuPont analysis framework breaks down return on equity, ROE, into its component parts: profitability, efficiency, and leverage. This shows how these different factors interact to drive overall financial performance. The balanced scorecard approach combines both financial and non-financial metrics to provide a more comprehensive view of company performance. This helps capture leading indicators as well as lagging ones. Some ratios are leading indicators that predict future performance, while others are lagging indicators that confirm past results. Understanding this distinction is important for interpreting the data. Correlation analysis examines the relationships between different financial ratios. This can help identify the root causes behind changes in performance and guide strategic decision-making. Financial ratios provide a comprehensive view of business performance, simplifying complex data into actionable metrics. However, interpreting ratios requires understanding the context. Industry standards, company size, and business cycle position all affect how the numbers should be analyzed. Tracking trends over time is often more meaningful than looking at single measurements. Patterns and changes can reveal important insights. Ultimately, ratios are analytical tools, not final answers. Effective interpretation requires sound business judgment and acumen to draw meaningful conclusions. The key is to use these financial metrics as part of a broader analysis, not to rely on them as standalone indicators of performance.